Welcome back. As President Trump's new 25% tariffs on Canada and Mexico go into effect, along with the 10% additional tariff on China, retail stocks are among the worst performers today, although the declines have moderated. Target, for instance, was down 6% earlier, about 2.5% today. Meanwhile, Dick's Sporting Goods, that's another stock on the move. Ralph Lauren, those are trading lower, but our next guest believes they could gain an advantage amid a higher tariff environment. Joining us now is Deborah Weinswig, the CEO and founder of Coresight Research. Deborah, welcome. Let's just start right there. Why could these two firms benefit?
I think that many of these companies in the, with Dick's and Ralph Lauren, right, they have been for the last few years moving production and thinking about where their sales are and trying to match sales to product. And so they're tending to have at this point more product in market, and they've really also shortened their supply chains as well. So those are two great examples of retailers who've kind of gotten ahead of it and will fare better than others.
What do you think about it? Look, Target, that was down sharply today. They said they might have to raise the prices of bananas and avocados in the next couple of days. Best Buy got creamed this morning. I'm not sure if that's still down double digits. They said their supply chain, not direct supply, but supply chain was primarily in China and Mexico. So what are investors supposed to do kind of navigating all this?
It's a great question and incredibly timely. So we look at the off-price retailers, so the Burlingtons, the TJs, et cetera, Ross stores, who source over 80%, most of them are like 95% domestically. And that, so they haven't had to get ahead of it. They already were there. Secondly, a lot of the CPG, so Clorox and P&G we spoke to, and they've both, kind of not only are they ahead of it, but once again, most of their production is domestic. You think about like the weight of a lot of what Clorox sells, so that's a great example. And then the industry that is a bit of a concern is the toy industry. Over 80% of that is sourced from China. And what, some recent news is, right, Lego is building a new factory in Virginia, so they're trying to move more of that locally. So I would say there's not a retailer out there who's not rethinking their supply chain. But, having spent a lot of time in the supply chain industry, it's incredibly complex and difficult. And, the good news is there's a lot of room for opportunity to cut costs and ultimately have, more efficiencies and lower prices.
Yeah, Clausen Quality Chocolate of Wisconsin actually just bought land in Virginia. I only know that because it's near my parents. It's all about the Virginia show. So there is some growth here. Deborah, listen, I'm not saying the tariffs aren't big. I have no idea what's going to happen. And I know everybody's already out of their minds paying enough for stuff. And that's my point. I know we're losing our collective minds about the tariffs, and they may crash the economy. I have no idea. But we've dealt with inflation for 4 years like we haven't seen in 30 years, and prices for so many things went up 20, 30, 40, whatever percent. Why is this the camel or the tax that broke the consumer's back? Because how is this different than all the higher costs that consumers are already paying everywhere for everything?
Brian, you're just too logical for me.
Damn it, I'll stop. I'm sorry.
But truly, I think the one thing that's gotten a lot of airtime is eggs, right? Eggflation or whatever we want to call it. And it's wild. So we track weekly consumer sentiment across the U.S. And when kind of egg prices really kind of hit that high a few weeks ago, that's when we really started to see a significant decline in consumer confidence, because I think all people heard was eggs, eggs, eggs. And consumers, 2 to 3% of their food budget is eggs. So it's something that they see every week. It's like the price of gas. And so I think that has had a contributing factor. But honestly, nothing is that much different today than it was 6, 12, 18 weeks ago. Supply chains are difficult. They're tricky. There's a huge opportunity to simplify it. And I think that we've gotten that opportunity handed to us on a silver platter to do so. So I'm totally with you.
Last word here, Deborah, as we go. What would you say kind of broadly about the space? You think it's going to remain in the crosshairs?
Oh, I think it's going to be volatile. I also think there's a lot more, right? Target said today 17% of their goods come out of China. I mean, there's a big focus on where goods are being sourced. And I think that what we're going to see is much more of an early delivery of holiday than we've seen in years past, because I think there are a lot of concerns. So that will be a big change. So we'll have probably additional inventory. But since this is being so well televised, I think people are going to shop early and make sure that they get what they need, because they just don't know if it's going to be there when they go back.